Hello, and in this chapter we're going to talk about risk and rates of return. So let's take a look at what's to come. So we're going to look at standalone risk, portfolio risk, and the relationship between risk and return. So what is investment risk? Anytime you take on an investment, we have two types of risk, standalone and portfolio. Investment risk is related to the probability of earning a low or negative actual return. You put money into an investment and that investment doesn't do well. That's an example of investment risk. The greater the chance of lower than expected or negative returns, the riskier that investment. We can make a probability distribution showing all possible outcomes and the probability of each one, and it can be shown graphically. In this case, both of these two investments have an expected rate of return of 15%, but one is more risky. One is more risky than the other. So as we look here, firm Y can stretch from negative 70 all the way to above 100, and firm X is the chances of negative numbers that far down are a lot less likely. Now these curves do stretch on forever, but the probability of that for firm X is a lot less. So they have different risk profiles even though they have the same expected rate of return. Here are some selected realized returns in about the last century going up to 2019 of the stock market. So small cap stocks, large cap, various bonds, government bonds, and different portfolios. Small and large cap stocks are by far the riskiest. Look at the standard deviations. Remember, the higher the standard deviation, the riskier something is. Bonds less so. And U.S. Treasuries are really low risk. U.S. Treasuries, remember, are one of the least risky investments. And then we can look at various portfolios, 90% stocks, 10% bonds, 70% stocks, 30% bonds, and they are less risky than all stocks. So we could look at some hypothetical investment alternatives for some various things. So depending on the state of the economy, ranging from a recession to a boom, we have different probabilities, and we can look at different things. T-bills are going to just earn 3% regardless. Remember, they earn the same at all times. We can look at high technology stocks, collections, rubber, and the overall portfolio of the market. High technology stocks seem to be the most risky, or the one that varies the most compared to the other three. So why is the T-bill return independent of the economy? So T-bills generally will return what they promise. The government has never defaulted on their debt as of yet, so they'll return the promised 3% regardless of the economy. They don't provide a completely risk-free return as they're still exposed to inflation, although very little unexpected inflation is likely to occur over such a short period of time. So they don't provide a completely risk-free rate of return, but very little unexpected inflation generally occurs. They can also be risky in terms of reinvestment risk. Reinvestment risk is the sense that the T-bill, if you reinvest it, you may not be able to get the same return as before. So now let's move on to slide number 8. And we're going to take a look at how do the returns of high tech and collections behave in relation to the broader market. So high tech moves with the economy and has a positive correlation. And this is typical. Most stocks do move generally with the economy and have a positive correlation with it. Collections, however, is countercyclical to the economy and has a negative correlation. Meaning as the economy does bad, collections actually does better. And you would say that this is unusual. How do we calculate the expected return? We calculate basically a weighted average of all of the possibilities, and we can find the expected return there. If we take a look at a summary of expected returns, previous slide was high tech, 9.9%, the market 8%, US rubber 7.3%, T-bills are 3.0 because remember they pay the same regardless of how the economy is doing, and collections 1.2. So high technology has the highest expected return and appears to be the best alternative, but is it actually? Have we failed to account for risk? Standard deviation is a measure of variation or a measure of how much spread is in your data. It is also the square root of variance. If you've taken a statistics course, you have encountered standard deviation before, and it is the difference in your returns. And if we want to take a look, let's take a look how it would actually be calculated. You're not going to have to calculate standard deviation by hand in this course, but understanding standard deviation and what it is very important. For the most part, you would use software to actually do this. So for T-bills, you're finding the difference between the returns here and the weights and squaring them. So the difference between the returns, square it up, multiply by the different scenario weights, and then we square root all of this. Obviously, T-bills have no standard deviation because the expected and actual returns are exactly the same, whereas collections and high technology, your expected return is what we calculated on slide 10. You take it away from the actual return and multiply it by the scenario weight, and then square root all of it. You also square the differences. Now, once again, you're not going to need to do this by hand. Usually you would use software such as Excel to generate your standard deviations if you needed to. But when we look here, why is standard deviation important? Obviously, T-bills, it comes in at 0 because there is no variation in your returns. No matter what happens in the economy, the T-bills are going to pay the 3%. High technology, 20%. So there's a lot of variation here. Collections 11.2, the overall market 15.2, and the US rubber stock 18.8. So the rubber and the high technology are a lot more variable than the market or the collections. And standard deviation is a measure of risk. Even though the average return of two things may be the same, if one has a much higher standard deviation, it means there is a much greater likelihood of the return you experience being very different than that average. If we look at standard deviations here, obviously T-bills does not have one, it's 0, so you're just going to get a 3% return no matter what we do. And this is looking at US rubber and high technology. So high technology has a larger standard deviation, so there's a much greater chance of big returns, but also bigger losses. Whereas US rubber, less of a standard deviation. Standard deviation measures total or standalone risk. The larger your standard deviation is, the lower the probability that actual returns will be close to expected. Remember, expected returns is a type of average. It's a weighted average. So if you have a really high standard deviation, the chance of what you experience, the returns you actually get, being different than that average are pretty likely. And a large standard deviation is associated with a wider probability distribution of returns or a riskier security. So if we want to compare risk and return here, T-bills expected return 3 and technically no risk. Remember, T-bills do have some risk, but they do not have market risk. Collections 1.2 expected return, risk 11.2, high technology 9.9, risk 20, US rubber 7.3, standard deviation of risk 18.8, and market 8.0 with a standard deviation 15.2. Collections and rubber seem out of place here because rubber has the second highest risk. However, the market has a higher return with a lot less risk. Collections has a pretty low standard deviation comparatively, but it also has an extremely low expected return, smaller than the T-bills. So we'll take a look at why this may be the case. The reason the expected return for collections is low, remember collections is something going opposite the market. So if the market is doing poorly, it'll do well. we want to take a look here at slide 16. One thing we can use is known as coefficient of variation, and this is a modification of your standard deviation. It's a standardized measure of dispersion about the expected value that shows the amount of risk per unit of return. So you divide your standard deviation by your expected return, and it shows the amount of risk per unit of return. And there are guidelines of what we would consider something risky or not. And we're going to see coefficient of variation more in later chapters to come. So what if we want to illustrate coefficient of variation as a measure of relative risk? So standard deviation of A and B are the same. The curves have the same shape, but A is riskier because of a larger probability of losses. So remember, these curves do go on forever. They never touch the axis, but the closer and closer they come, the less and less probable something is. So a big chunk of the purple curve is below zero return. Therefore, there is a good chance you wind up with a negative return with security A, whereas security B has a much lower chance. So we would argue security A is riskier because the larger the probability of a loss, the greater the risk. So same amount of risk measured by standard deviation, so it has the same amount of variation, but all of the returns are going to generally be smaller. So coefficient of variation, in this case here, they have the same standard deviation, but coefficient of variation would be different because the rate of return is different on both of these. One is riskier than the other. If we look at the risk by coefficient of variation, T-bill 0, market 1.9, high technology 2, US rubber 2.6, and collections 9.8. So collections has the highest degree of risk per unit of return, and high tech, even though it has a really large standard deviation, because the expected return is so high, it has a pretty average coefficient of variation. Another way we can gauge risk is something known as the Sharpe ratio. And the Sharpe ratio is an alternate measure of risk, and it looks at excess return relative to risk. We use the T-bill rate as the risk-free rate here, and then find excess return relative to risk. That's what we're doing here. We're taking out the T-bill number from the expected ones for all of these. High technology 0.345, US rubber 0.229, market portfolio 0.329, collections is negative 0.161, and T-bills are 0. Excess return is an asset's return minus the risk-free rate, and risk is your standard deviation. Risk-free assets will always have a Sharpe ratio of 0, and if we look right here, why is collections negative? Collections is negative because it moves opposite the market. Collections would be like debt collection companies. Obviously, they do very well when a lot of people are in debt and not paying, and then they get a lot of business. So if the market is doing very well, collection companies probably aren't. If the market and the economy is doing poorly, the collections companies are probably going to be doing well. So investor attitude towards risk, and this is important. If you're going to take on some sort of a risky investment, you want it to be worth your while. If I can earn 3% buying T-bills and they're virtually riskless, I'm not going to want to buy some risky stock if I'm only going to expect to make 3% from it. I'd be much better off buying the T-bills and just basically being guaranteed my money. So risk premium is going to be the difference between the return on a risky asset and a riskless one, and it serves as compensation for investors to hold riskier securities. If you're going to take on more risk, you're going to want to make more reward as a consequence, and that's what's known as a risk premium. Risk aversion assumes investors dislike risk and require higher rates of return to hold riskier securities, and this is true. So the risk premium factors right into that notion of risk aversion. So risk aversion is the fact that people really don't like risk, and if you're going to take that risk on, there has to be a chance of a larger reward. Portfolio construction pertaining to risk and return. So let's assume we have a 2-stock portfolio with $50,000 invested in both high tech and collections. A portfolio's expected return is simply a weighted average of how much of each assets make up the portfolio. And standard deviation might be a little more tricky and require a new probability distribution for the portfolio returns to be constructed. Once again, RP, or return on portfolio, expected return, that's what the little chevron means, is simply a weighted average of what is making up this portfolio. So half of it is high technology, half of it is collections. Expected weight is simply a weighted average, or 5.5%. That's our expected return. An alternate method for doing this is, once again, find every scenario for our component pieces and see what happens. So in a recession, and above and below and boom and all of that, we find what happens with high tech and collections, find how our portfolio would do in all of them. So in a recession, -2, below average 0.5, average 5.8, above 11.3, boom 11.3. So those are our various scenarios our portfolio can do. And we can find the expected return. We can find the expected return right here, 5.5%. Simply, once again, a weighted average. We can find the coefficient of variation as well. So we find the standard deviation of the expected and the actual for all of the scenarios of our portfolio. So our portfolio is a standard deviation of 4.6% and coefficient of variation 0.84. And we can find our Sharpe ratio as well, 0.543. So what are some comments on our portfolio risk? And this is a very, very important point. This is one of the biggest takeaways of this chapter. Our portfolio standard deviation is 4.6%, and this is much lower than either of the stocks. High technology was 20%, collections 11.2%. It's lower than the weighted average of high tech and collections as well. If we just did a weighted average of both of those standard deviations, it would be 15.6%. So the portfolio provides the average return of the component stocks, but lower than average risk. And why? Negative correlation between the stocks. Since they're opposite each other, when one does good, the other does bad, and vice versa, it's going to make your portfolio a lot less risky. You're not going to get huge downswings, because even if high technology does bad, collections will be good, and vice versa. When collections does bad, high technology will do well. And we actually have terminology for this we will touch upon pertaining to making stock portfolios, or what is known as diversification. But if you hold different types of securities, you can offset various types of risk. So average stocks have standard deviations of around 35%. This is a real stock now we're talking about. We were looking at some made-up stocks for the last few slides. But the average stock trading on the market has a standard deviation of around 35%. And most stocks, but not all, are positively correlated with the market. There are companies that do good when the market does good, they do bad, and vice versa. But most stocks are generally correlated with the market. Combining stocks in a portfolio generally lowers risk, and this is a very, very important point. It has a term. That term is known as diversification. We'll go into more reasons why it works, but simply holding one stock in your portfolio is not a very smart way to go. You're going to want a varied mix of securities that is going to allow you to reduce your risk. So putting all of your money into one stock is a lot riskier than assembling a portfolio. If we have two perfectly negative correlated stocks, this could be the return distribution. So we can have stock W and M held separately. So if held separately, they can range from -10 to 40% with an average of 15%. Since they're perfectly negatively correlated, and in real life, you're never generally going to find a stock that is perfectly negatively correlated. But if you did, By holding both of them, you would just be able to guarantee a 15% rate of return. They would offset each other at certain points, and you would be able to guarantee at any point in time a 15% rate of return by holding both of them, if you found two stocks that had a perfect negative correlation. Here are two perfectly correlated stocks. So M and M with the little apostrophe, they move exactly the same. Obviously, the portfolio of both of them is going to move exactly the same as well. Since they're perfectly correlated, having both of them is going to perform exactly the same as having one, because that means they move in exactly lockstep together. So if you have perfectly negatively correlated ones, you can guarantee a return no matter what. In this case, the expected return is 15%. Holding both of them does not really change the distribution of returns. But what if we have partial correlation? And this is where it gets interesting. Partial correlation is what we would really expect in a lot of actual stocks. They're never going to be perfect negatives and perfect positives unless you make your own test data in Excel or something like that. But real correlations are somewhere between those things. So we have two stocks that are correlated to 0.35. So we have a correlation of 0.35 positive. So they do move together, but not super strong. If we hold them separately and we look at our curve, we have an expected return in both cases of 15%. But there's a more high likelihood of losses on both ends. As you look, this is going to 40 and 10. It's stopping before, and the area under the curve where there is most of the area is much closer to that 15% than here. So the portfolio holding both of them is less variable. It has less risk. The one where we hold each of them separately, there's more risk than holding them both. So even though it's not going to guarantee, it's not perfectly negatively correlated and we can guarantee a set return, we are offsetting a good chunk of risk by doing this. So if we create a portfolio, let's say we begin with one stock and add randomly selected ones to our portfolio. Our standard deviation is going to decrease as stocks are added because they would not be perfectly correlated with the existing portfolio. We saw on the last slide we had two that weren't perfectly correlated and our risk went down. Our standard deviation or our variability dropped. Expected return of the portfolio should remain relatively constant. And it has a term, and this is a term you can expect to see on assignments and tests. It's known as diversification. Diversification is the notion that if we add more investments to our portfolio, we can offset risk. Eventually, diversification benefits of adding more stocks starts to dissipate after about 40 stocks. And for large stock portfolios, generally your standard deviation of your portfolio will converge to around 20%. So we remember, in real life, the average stock has a standard deviation around 35%. We can get that variability down to around 20%, give or take a bit, by diversifying. So diversification is very important. It is going to remove some risk by holding more than one stock. If you do plan on investing or becoming knowledgeable about investments, or maybe want to take more classes on this information, one thing to realize is holding one stock and one stock only with all of your money, or any security, it doesn't have to be a stock, it could be a bond or anything like that, is unnecessarily risky. A diversified portfolio is a much better way to go. So if we want to look at diversification effects, as the portfolio's risk comes down, if we hold one stock, it's going to be right around 35%. As we get up to that magic number of 40, we're down to about a little over 20%. And as we add more and more stocks, the risk does drop slightly, but very, very little. After about 40 stocks, you're splitting hairs here. Now this light blue area, what we're looking at right here, this is known as market risk. And market risk we can't do anything about. Obviously, the stock market is risky, and investing in securities is risky. Market risk we can't get rid of by diversifying, and that's something to remember. Diversifiable risk, yes, we can get rid of that. We can bring our standard deviation down a good amount by simply holding an adequate mix of securities. So if we have diversifiable risk like right here, it can be gotten rid of by or reduced by adding more stocks. But the light blue area, this is what is known as market risk. That's always going to be present. Total risk is your diversifiable risk and your market risk added together. If you're a savvy investor, once again, you would want to try to eliminate that diversifiable risk. That's something you have the power to get rid of, whereas market risk, that is just a function of the fact that financial markets are, by their nature, risky. Standalone risk is equal to market risk plus diversifiable risk. So market risk is what we can't eliminate, and we measure it with something called beta. We're going to take a look at beta in a moment. And diversifiable risk, that is a portion of a security's standalone risk that can be eliminated through diversification, making sure you hold enough securities that aren't perfectly correlated. So being diversified is very important. It gives you a much less risky portfolio, but do remember that market risk can never be diversified away. There's always going to be market risk when you invest in stocks. What about failure to diversify? If an investor chooses to hold a one-stock portfolio, or what I was saying a little bit ago, would the investor be compensated for the extra risk? And this is why you would never want to do this. The answer is a resounding no. Remember, if we buy a really risky bond like a junk bond, or if we buy a really risky stock or anything like that, generally we're going to expect a higher rate of return. But if you just simply put all of your money into one stock, you're holding all of this diversifiable risk, which you're getting no additional compensation for. Standalone risk is not important to a well-diversified investor. So if we're talking about rational, risk-averse investors, they're concerned with their portfolio standard deviation, and that's based on market risk. There can only be one price, the market return for a given security, so you can't earn any compensation or extra compensation or any extra return for holding unnecessary diversifiable risk. So if you hold diversifiable risk in your portfolio, we took all of our money and we plowed it into one stock. Well, if you do that, you have all of the risk and none of the extra return. You're getting absolutely nothing more. You're going to earn what that stock earns, but you're holding a lot more risk than you should, because you should be able to diversify in a way. So diversifiable risk is not something that we are compensated for, and it's something we want to make sure we get rid of if we are a rational investor. How do we actually price? How do we actually link risk and required returns and do some of this pricing here? We use what is known as the capital asset pricing model, and that's something that's going to show up again and again in the next few chapters. So our return that we are interested in is going to be this one right here. The return on our investment is equal to the risk-free rate, so usually the government security rate or the T-bill rate, plus the difference between the market return and the risk-free rate times beta. And we'll get into what beta is in a moment. Now, beta is the relative riskiness of a stock in regard to the market. But if we look at our primary conclusion here, the relevant riskiness of a stock is its contribution to the riskiness of a well-diversified portfolio. I just gave away what beta is, but what's beta? Beta measures a stock's market risk, and it shows a stock's volatility relative to the market. It indicates how risky a stock will be if the stock is held in a well-diversified portfolio. And that's a very important point. Remember, we don't have any additional premium or anything for diversifiable risk. So when we're examining all of this stuff, we're making the determination that they're being held in a well-diversified portfolio. What are some comments on beta? If beta is 1, it's risky as the average. So keep that in mind. If a stock has a beta of 1, it is just as risky as the average stock. If a beta is greater than 1, it's riskier than average or riskier than the market as a whole. If it's less than 1, it's less risky than average. Most stocks that we see and that trade on market, the regular exchanges on the market, have beta somewhere between 0.5 less risky than the overall market, 1.5 more risky. You can get securities that have far greater than 1.5 betas, And you can get securities with a negative beta. We're going to look at that at the next slide, and we'll go into what it means. But do realize negative betas are pretty unlikely. So can a securities beta be negative? The answer is yes. If the correlation between a stock and the market is negative, so we looked at the collection stock before, that was a good example of something that would have a negative beta. So if the correlation is negative, we would have the stock moving opposite the market and our beta would be negative. Meaning as the market does well, the stock's going to do poorly. As the market does poorly, the stock is going to do well. But negative betas are highly unlikely. Remember, the overwhelming majority of stocks do move in the same direction as the broader market. But there may be one, so that collections one was an example, where it is a company or some sort of a security that is designed to do well when the overall economy is doing poorly. So a negative beta is highly unlikely, but not impossible. If you have a negative beta, it means that the stock is moving opposite the market. How do we calculate beta here? So well-diversified investors are primarily concerned with how a stock is expected to move relative to the market in the future. Without a crystal ball to predict the future, analysts are forced to rely on historic data. And a typical approach to estimate beta is to run a linear regression of a stock's past returns against the past returns of the market. And you could say the slope of that regression line is its beta coefficient. Linear regressions we generally use software to run, and it is going to basically make a line that is going to use that past data to analyze what beta will be in this case. So if we look at the calculation of beta here, they did a regression line and its slope is going to be equal. Its slope is going to be equal to the stock's beta. The slope here is 1.44. So 1.44 here would be this stock's beta, meaning it's more risky than the market as a whole. So this one would be more risky than the market as a whole. So betas for all of them. High tech would have a beta of 1.31. It's riskier than the market, but it also has a higher expected return. T-bills beta 0 because once again, no risk. Collections beta negative 0.05. So here's an example of a negative beta. As the market does good, collections will do poorly. As the market does poorly, collections will do good. So here would be return of the market and return on collections. So if the market has a negative return, as you can see, collections has a positive one. Here's your return on the market, and here's your return on the security. So it's moving opposite the market. Rare that you see negative betas, not impossible. So if we want to compare expected returns and beta coefficients, let's take a look. High technology, that's your highest beta, highest expected return, market 8 and beta 1. Market will always have a beta of 1 because it's equivalent to the risk of itself. US rubber 7.3, beta 0.88. T-bills 3%, beta 0.00, and collections 1.2%, beta negative 0.5. Riskier securities have higher returns, so we would say this rank order is correct. If we want to find our required rate of return, what would we actually do here? So assuming that our risk-free rate is 3%, and we want to find the risk premium for the market, we know the market's returning 8. We can get 3 with T-bills. So to take on the extra risk of the market, you're getting a risk premium here of 5%. So every security has a risk premium baked in. It's the difference between what its expected return is and the risk-free rate, or what you could earn by buying something like a T-bill or a government security. So in this case, the risk-free rate is 3%. The market earns or is expected to return 8. So you're getting a 5% risk premium for taking on the additional risk of the market. What is the market risk premium? Well, once again, I kind of gave it away on slide 42. It assumes it's the additional return over the risk-free rate needed to compensate investors for assuming an average amount of risk. So the risk premium for the market is if you take on that average amount of risk or the market level of risk, this is how much additional return you're going to get from something like a T-bill. It does change. It's not static. The risk premium of the market varies, and its size depends on the perceived risk of the stock market and investors' degree of risk aversion. Those are things that aren't set in stone. They do change. So as they change, the risk premium of the market varies. And it varies from year to year, but most estimates suggest it's ranging somewhere between 4 and 8% in any given year. And if we want to look at required rates of return, we know what they are all here, and here are our risk premiums. So our risk premiums here, 3%. So high technology, the market, U.S. rubber, T-bills, and collections. So we find our risk premium by multiplying beta by the market risk premium. The market risk premium is 5%, so for each of these we multiply 5% by beta and find the risk premium for each of the individual securities. Expected versus required returns. So those are our required rates of return using the market risk premium. So high technology has a required rate of return of 9.55%. That's using beta, the market risk premium, and the risk-free rate. We're expecting 9.9. So we would say that's an undervalued stock. The market's obviously fairly valued. Expected and required will always be the same. U.S. rubber has a required return of 7.4 given its beta and its information, but it has an expected return of only 7.3. We would therefore say it's overvalued. Undervalued stocks are attractive stocks to buy. Overvalued ones, if you hold them, you either want to sell them or you certainly don't want to buy them at that point. T-bills are always going to be fairly valued because expected and required will once again always be the same. And collections here, the required, remember, was only 0.5, expected 1.2, so we would say that is undervalued as well. So high tech and collections would be decent buys. Rubber overvalued. The market obviously is fairly priced, and T-bills are always going to be fairly priced as well. So we could look at the securities market line here. So the market has a return of 8% with a beta of 1, and we could look at the different betas and the different returns for all of the things we looked at. We have collections with its negative beta, T-bills with its beta of 0, rubber beta 0.88, and technology beta was, I believe, 1.31. Note, high tech is above the line and collections is above the line. That means they are undervalued. They're undervalued. U.S. rubber is below the line. It's overvalued. Market and T-bills are directly on the line. Those are fairly priced. So what if we wanted to create an equally weighted two-stock portfolio? What would its beta be? So if we put, once again, 50% in tech and 50% in collections, it's once again a weighted average. Tech has a beta of 1.31, collections negative 0.5. Just do a weighted average and you would get a portfolio beta here of 0.405. So if you made a portfolio of tech and collections, it's going to be significantly less risky than the market. The market beta is 1.0. Relative to the market, it's a lot less risky. Calculating portfolio required returns, and once again, this is the weighted average of each stock's required returns. So we could find the weighted average of technology and collections. So the required return here would be 5%. Or we could use the CAPM formula, risk-free rate 3%. Our risk premium of the market is 5, and our portfolio's beta 0.405. You're going to get 5% in each case. So that's the required return of this portfolio, and I believe when we looked at this exact portfolio a few slides ago, it was going to return more than 5%. It was 5 and change percent. So that would be a undervalued portfolio there. Its required return is less than its expected. That's a good thing. Factors that can change the security market line. So if you have inflation, what happens? Well, if you have inflation, it's just going to raise the rates of everything. So 3% inflation is going to raise the return of the market from 8% to 11. You're not actually making any more money. That's just the inflation being baked in, and the line is just going to shift upwards. Otherwise, it's going to work exactly the same. What if risk aversion increased? What would happen to the security market line here? So if risk aversion increased, they're now no longer parallel. They're diverging apart. So if you have inflation, you just automatically add the inflation. If risk aversion increased, causing the market's risk premium to increase by 3%, what would happen? Since the risk premium changed and not all of the rates due to inflation, the riskier something is, the gap between these lines is going to widen. So it's widening the riskier they are, because beta is now coming into play. The risk premium, remember, gets multiplied by beta. If beta is more than 1, you're going to watch these lines drift apart more and more. Whereas if it's just due to inflation, nothing changes other than the new line shifts up by however much inflation there was. And finally, verifying CAPM empirically, and we are going to look at CAPM more. It hasn't been completely verified. Statistical tests have problems that make it almost impossible. And you could argue there are other risk factors, such more risk factors than just the market risk premium, but this is debatable. All metrics and predictions are useful and they have good purposes, but there is no such thing as perfect predictions no matter what you do, so keep that in mind. So for verifying the CAPM here, it can't be perfectly verified. However, it is still very useful. With that said, that's going to take us to the end of the chapter.